Warren Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." And if you think about it, that one sentence explains why 98% of people fail at investing, while just a small minority, the 2%, actually succeed and build life-changing wealth. Most beginners come in chasing quick wins. They try to time the market, follow the latest hype, or jump in and out of stocks at the worst possible moments. And on paper, it feels exciting, like they're doing something. But in reality, they're digging themselves into the very trap Buffett warned us about. Now, here's the surprising part. Starting the right way isn't about being smarter or luckier or even having more money than everyone else. It comes down to a method so simple, most people ignore it. Yet it's the same method Buffett himself has used for decades. And in this video, I'm going to break down exactly how you can apply it, even if you're starting from scratch. Here's the thing most people don't realize when they begin. Investing isn't actually about picking the perfect stock or predicting what the market will do next week. It's about building a system, a way of investing that works in good times, bad times, and even boring times. Think about it. The market goes up and down, but your bills don't stop, your future doesn't pause, and retirement doesn't wait for the perfect moment. And yet, this is where so many beginners get stuck. They think they need to wait for the next crash, or read the news every morning, or somehow outsmart Wall Street. But here's the uncomfortable truth. That approach almost guarantees failure, because the harder you try to be active, the more likely you are to make emotional decisions. Fear makes you sell what you should hold. Greed makes you buy when you should wait. And little by little, the market takes money from the impatient and gives it to the patient, exactly as Warren Buffett has said. Now, here's the interesting part. When you cut through all the noise, Buffett's approach is actually very straightforward. It doesn't rely on complex strategies, secret information, or staring at charts all day. It's something you could set up once, keep going with very little effort, and let time do the work. Years down the road, you'll see how wealth has been growing steadily in the background, and almost without noticing it. But before I reveal what that method actually is, let's talk about the biggest mistake beginners make when they first put money into the market. Because if you fall into this trap, and most people do, it won't matter how much you invest or what stocks you pick. You'll always feel like you're running in place, while others seem to get ahead. The biggest mistake beginners make is trying to chase perfection. They wait for the right stock, the right entry point, or the right market conditions. And while they're waiting, opportunities slip by. Or worse, they jump in too fast, following a hype, and end up buying at the very top. It's a cycle that never ends. One month, they're afraid of missing out. The next month, they're afraid of losing money. And in between those two fears, nothing gets built. No real foundation, just a string of emotional decisions that leave them more frustrated than before. Buffett understood this decades ago. That's why he never plays the timing game. Instead, he created a system that doesn't care whether the market's going up or crashing. A system where every dollar you put in works for you, whether today looks exciting or boring. But here's the part most people overlook. Investing isn't about what happens this month or even this year. It's about where you'll stand 5, 10, or 20 years from now. And when you shift your mindset from quick wins to long-term wealth, everything changes. Suddenly, market dips stop being scary and start becoming opportunities. And that's exactly why Buffett's way is so powerful. It changes the game. Instead of stressing about what to buy today, you focus on building something permanent, something that grows while you live your life. Buffett avoids that trap by taking emotions out of the equation. Instead, he follows a simple system. Put money into great businesses consistently and hold them for the long run. You might know this as buying and holding, but there's more to it. Buffett doesn't just buy randomly. He looks for companies so strong and reliable that he can trust them to keep growing for decades. These are businesses with what he calls a moat. Think of it like a castle protected by deep water around it. The moat makes it hard for competitors to attack. In business terms, it means a company has something unique. This could be its brand power, cost advantages, or maybe its loyal customers that keeps it strong even when the market gets tough. Now, here's where beginners usually mess up. They hear Buffett say, "Buy great businesses and hold them forever," and they think that means finding the next Coca-Cola or Apple on their own. But that's not what Buffett wants you to do. He knows most people don't have the time or desire to dig through financial statements or research dozens of companies. Instead, he points to something much simpler: an index fund. An index fund is just a basket of many different stocks grouped together to match a certain index, like the S&P 500. And the S&P 500 is simply the 500 biggest companies in America, which includes names like Apple, Microsoft, Johnson & Johnson, Coca-Cola, and many more. By buying into the index fund, you're instantly invested in all of them at once. You don't have to pick winners because you own the whole group. And the easiest way to invest in an index fund is through an ETF, which stands for Exchange Traded Fund. An ETF is just like a normal stock you could buy on your brokerage app, but instead of owning one company, you're buying a whole collection of them in a single click. A popular S&P 500 ETF is called VOO. So when Buffett says for most people the best thing to do is to own the S&P 500 index fund, this is what he means. Buy an S&P 500 ETF, keep adding to it consistently, and let time do the heavy lifting. With one move, you're betting not on one company, but on the strength of the entire US economy. And if there's one thing history's shown us, it's that despite recessions, wars, and crashes, the US economy keeps growing over the long term. Now, here's the part that ties it all together. It's not just about what you invest in, it's about how you invest. Because even if you buy the best fund in the world, it won't work if you only throw money at it when you feel like it. This is why Buffett emphasizes consistency. You invest the same amount of money at regular intervals, whether the market's going up or down. This simple approach is called dollar cost averaging. And while the name sounds technical, the idea is very simple. Imagine you invest $200 every single month into an S&P 500 ETF. Some months, when the market's high, that $200 buys you fewer shares. Other months, when the market dips, that same $200 buys you more shares at a lower price. Over time, it all balances out. You're automatically buying at both the highs and the lows, without ever having to guess the right time. And here's the powerful part. This strategy turns fear into an advantage. When most people panic about falling prices, dollar cost averaging means you're actually picking up more shares at a discount. What feels scary in the short term is actually what accelerates your wealth over the long term. If you had started investing just $200 a month into an S&P 500 index fund 20 years ago, you would have to put in around $48,000 of your own money. But thanks to the growth of the market, that steady habit would have turned into $150,000 today. That's more than 3 times your original investment, all from just logging into your brokerage account once a month and buying more of the S&P 500 fund. That's the power of Buffett's way. It's not about excitement or quick wins. It's about building wealth so consistently that one day you look back and realize the numbers have snowballed into something life-changing. And if you're ready to start applying Buffett's way in your own life, I put together a free ebook called The Ultimate Investing Guide, and it gives you the exact 5 steps to start investing the right way, from choosing your first ETF, to setting up your account, to making your first investment. You can download it right away through the link in the description, or just go to griffinwise.com.